Hi everyone, welcome to another video on this channel. Today we are going to talk about multi-factor mutual funds. Now this is a new category in the mutual fund world, Indian mutual fund world. Not too many funds are available in the market on this category, but we are still going to cover this. As you know, the purpose of this channel and most of the videos on this channel is to explain the basic concepts of mutual funds and investments to people who are new to this world, people who are just testing the waters or kind of undecided, between whether they should enter the market or not enter the market. The idea is to present all these complicated concepts in a very, very simple and easy to understand words and manner. My name is Paresh. I am an NISM certified and AMFI registered mutual fund advisor and distributor. This is my ARN 334516. On the right hand side, you will see a QR code. You can scan this QR code using your mobile and download the Funds Bazaar app. Register yourself on the app and you can start investing in mutual funds right away. Before we move ahead, this disclaimer is necessary. Mutual fund investments are subject to market risks and you need to read all scheme related documents carefully. The past performance of any mutual fund scheme is in no way guarantees or indicative of its future performance. I will leave you all with this disclaimer for a few seconds before we move ahead. Please read this carefully. Right. So when a new mutual fund investor, enters the world of mutual fund investing, the first problem that they face is confusion, right? Because there are just too many fund categories. If you go to any mutual fund website today, you will find some 50, 60 different schemes, and you don't know which scheme is right for you first. And new investors don't even know what each of these schemes entail or what they contain or what are their investment frameworks. So there is arbitrage fund, there is flexi cap fund, there is hybrid debt, large cap, ELSS, multi cap, mid cap, equity savings. What is this all? Right? It's very easy to get confused, and that is the purpose of this YouTube channel. In the past, we have explored some of these categories in sufficient detail so that you have an understanding of what each category means. We have looked at flexicap, we have looked at multi-asset funds, and today we are going to look at multi-factor funds. But be assured, rest assured that the remaining categories will also be explored in future videos on this channel. So do not forget to subscribe to this channel. Okay, so what are multi-factor funds? Now, pay attention to this video because this is not really an easy category to understand. Just like multi-asset funds, the past video which I did on multi-asset funds, I told you this was not an easy category to understand. This is something like this, right? So multi-factor funds are basically mutual funds which are based on an investment approach called as or known as factor investing, right? So this is a data backed investment strategy that focuses on specific factors or characteristics to choose stocks and enhance return potential, right? So remember, this is a data backed investment strategy. What does that mean? It analyzes past data, right, to identify which stocks fit which factors. So what are factors? Factors are proven characteristics that influence how stocks perform over time. So there are certain common factors. Okay, one is momentum. So what does momentum factor say? That recent winners will keep on being winners in the time to come. What does that mean? If certain share or a certain stock has done well in the last, say, few weeks, it will continue to do well in the coming weeks. So that is the meaning of momentum factor. Another popular factor is low volatility. So what are low volatility stocks? These are the stocks whose prices don't change, or don't fluctuate too rapidly with market fluctuation. Right? So they are relatively stable performance. Typically, these are large cap stocks. Okay, very large companies like Reliance, Tata, Infosys. These kind of companies or these kind of shares typically have low volatility. See, how can you understand volatility in simple terms? It says that, okay, let's say the stock market crashes by 10%. How much does that particular stock crash? Does it crash by more than 10%? Then it's not a low volatile stock, right? But if it crashes by less than the market crash, right? So if the Sensex has declined by, say, 10% over a few weeks, but this particular stock has declined only by 5%, which means it's a low volatility stock, right? And remember that this applies on the upside also. Let's say if the Sensex increases by 10% over a few years or over a few weeks, then this stock might not go up by 10%, it might only go up by 4 or 5%. But these are the stocks which provide some sort of stability to a portfolio. The next factor is quality. So what does quality mean? You choose companies or you choose stocks which have a strong fundamentals. Fundamentals means the company's balance sheet, the company's financial ratios, the company's financial position is quite strong. Maybe its profitability ratio is quite stable, higher than competitors. Maybe it has a good cash balance. Maybe it has shown consistent growth in its revenues over the last few years. That is the meaning of quality. The next factor is value. Now this is a very important factor because you must have heard, right, something called as a value investing, or there are many mutual funds out there who claim to be value investors. So we will cover this category in future videos. But see, value investing basically means buying stocks below their fair market price. So these are basically undervalued stocks. So there is a mathematical uh, formula, which you can use to arrive at a fair market value of a stock. It's a complicated exercise. This is not really a layperson's domain. But remember that there is a mathematical formula to arrive at a fair market price of almost any stock. And if the price that you arrive at, after doing all this analysis, is more than what the share price is currently trading in the market, which means, let's say your analysis says that this company share should be valued at 100 rupees per share, but the current market price of that share is, let's say, 70. That means it's a value pick. Why? Because the market is not understanding its potential. You have identified its potential way ahead of the market, and that's why you should buy. So that is what is called as value investing. Now I am focusing more on this value factor because this is a very, very proven strategy, right? So a lot of the great investors you keep hearing about, right? Warren Buffett, Peter Lynch. I covered Peter Lynch in some of the previous videos. These investors are proponents of value investing. So their entire investment strategy is based on value. The next popular factor is size. So what this factor says is that smaller companies with high growth potential. So you identify smaller companies, but who can grow at a very high rate, right? So this is typically, you can think about mid cap or small cap stocks, right? Uh, as we saw, or in the video about small cap investing, the potential of getting a multi-bagger means a stock which can say, triple or quadruple in just a matter of few years or months. Those kind of opportunities are only available in small cap segment, or maybe to a certain extent mid cap segment. When you come to large cap segment, we are talking about large companies like L&T, Tata, Reliance. These stocks are not going to quadruple in a matter of months. So these are some of the popular factors, right? And then each stock which is trading in the market is graded on each of these factors. Which stock has which which stock belongs majorly to which factor, right? And that's how you decide on which stocks are momentum stocks, which stocks are low volatility stocks, which stocks are quality stocks. So why choose multi-factor funds? Okay, now this is important. Okay, so different factors win in different market cycles, right? So momentum will perform better in a market cycle, while in some different market cycle, maybe quality or value will perform better. So what are market cycles? Typically, there are three types of market cycles. One is bull market, when the market is rising. Other one is bear market, when the market is falling. And the third market cycle is recovery, when the market has fallen but now it has slowly started to increase. So that is called as recovery. Now look at this table. Okay, so what they have done is basically they have looked at the last four market cycles across each of these category. Last four bear cycles, last four bull cycles, and last four recovery cycles, right? So if you look at the columns, see momentum, right? And this is a color graded table. What does that mean? Green represents better performance, while red represents bad performance. And the shades of green or red are indicative of performance in between. So dark green is the best performed, and dark red is the worst performer, and all other shades are like lying between best and worst, right? So if you look at momentum. I have highlighted this. Look at the column momentum. Where does it have the maximum green shades, right? You can see that during bull market it has almost all, right? Out of four, there are three green shades and one is like slightly orange, which means momentum does well in bull markets. It is a proven, uh, kind of a phenomenon, right? So momentum factor will always do well in bull markets. Why? Because in bull markets, if a company share price is doing well, it keeps doing well until the market is, until the market keeps rising. The second factor is value factor, and this is very important, right? So if you look at the value column, it is doing well in bull and recovery phases, right? So if you look at the recovery row, right? Now forget the value column, look at the recovery, the last four rows of this table. It's the value factor which has done consistently well, right? So if you look at the last row, right, we are looking at 27th October 2023 to 30th November 2023. Value factor has returned 13.9%, while all other factors are below that. So this is also a known phenomenon that value factor will perform well during recovery and to a certain extent during bull market. Now, low volatility and quality, these factors typically perform well during bear markets, right? So if you look at these two columns as well as rows, they are almost all in green color, those two columns during the bear market. So remember this very simple thing to remember, that momentum factor does well during bull markets. Value factor typically does well during bull and recovery, but mostly during recovery. And low volatility and quality factors do well during bear markets. Now remember, do well doesn't mean they give you positive returns, right? So look at the look at the first four rows again, right? Low volatility. So from 4th March, I'm looking at the first row in the table. From 4th March 2015 to 25th Feb 2016, this was a bear phase, right? Momentum stocks gave an average return of minus 15.7%, right? But low volatility stocks gave a return of minus 13.3 and quality stocks gave a return of minus 9.3, which is which is more than momentum factor and value factor, because value factor gave a return of minus 26.3. So the green shades in this column, or in this table, and a couple of other tables which we will see in later slides, do not necessarily mean positive returns, but they mean they have given better returns than the other factors, right? So this is the first reason that different factors win in different market cycles. So depending on whichever market cycle you are in, you have to bet on stocks belonging to different factors. Now, rather than you doing it yourself, the fund manager is doing it on your behalf, right? So if, let's say, currently we might be in a bear market, right? So low volatility and quality stocks are probably going to do well. So the fund manager will probably shift the holdings to low volatility and quality stocks. But now once the market kind of enters recovery phases, the fund manager might want to shift the holding to value stocks. Why? Because value does well in recovery phase. Now, once the recovery is complete and market enters the bull phase, the fund manager might want to shift the holdings more towards the momentum stocks, because momentum stocks do well in a bull market. So this is the entire gist of this category. Multi-factor funds, the fund manager is taking a calculated bet depending on which market cycle we are in and which factor is going to do well, right? Another reason to choose multi-factor funds is that no single factor outperforms every year. Okay, so relying on one factor requires conviction and timing, which can be difficult to sustain. Now again, look at this table, right? So from they have kind of enumerated data from 2015 to 2025, that's like last 10 years, and how different stocks belonging to different factors have performed over these years. Now the important thing to notice here is that look at every column, right? You will not see, so first four columns are the first four factors: momentum, low volatility, quality, and value. There is not a single column in this table which has all green, right, or all red. What does that mean? Every factor year on year keeps giving different types of return. So momentum stock gave an average return of 11.3% in 2015, but the same stocks gave a return of minus 0.8% in 2016. The return again went up in 2017. They gave around 70% return, but the following year, the momentum factor gave a negative return of around 10.7%. So that is the idea that if you combine stocks belonging to different factors in a single portfolio, that portfolio will kind of even out these performance jumps and troughs which you see. One year you are getting 11% return, the other year you are getting minus 1% return. One year you are getting 70% return, the next year you are getting minus 11% return. This is for momentum. Similarly for low volatility, quality, value, right? And the third reason and the final reason, or kind of a gist of everything, is that a multi-factor strategy brings balance to the portfolio, as I explained earlier. By combining factors that perform differently across market environments, it aims to mitigate single factor risk and overall risk adjusted returns. So you are not depending on any one single factor. You're not really dependent only on momentum. You're not really dependent on just value, but you're combining stocks which have different factor drivers, so that no matter what the market cycle is, your overall portfolio will do better than any one single factor, right? So these are some of the important statistical parameters that are looked at. So momentum, you're looking at price momentum, earnings momentum. When you're looking at say low volatility factor, you're looking at Sharpe ratio, Sortino ratio, realized volatility. These are all statistical terms. In future videos I might want to explain each of these statistical terms. But see, as a new investor to mutual funds, you don't really need to get into the mathematical details of all these things. You just need to understand what different factors are, what are their drivers, and how they correlate with each other, which we saw in previous slides. The third factor is value. You look at something like an intrinsic value, relative value, valuation ratios. And for quality factors, you look at earnings quality, sales and earnings growth, and balance sheet strength. So however, remember, there are certain inherent risks in multi-factor funds. See, multi-factor funds are typically driven by an algorithm or a financial model, right? What does that mean? The algorithm or the financial model that the fund manager or the fund house has designed automatically grades certain stocks, say top 200 or top 250 stocks in the market in terms of market capitalization, will be graded on these four or five different factors. And the model decides, okay, this stock belongs to momentum category, this stock belongs to low volatility category, this stock belongs to a quality category and value category, and so forth. So the fund manager, as a human, so there is very little scope for human judgment. The model has back tested the data. The model has decided which stock belongs to which category, and depending on market factors, the model automatically allocates the allocation of different types of stocks. So there is a model risk here, okay? Although most of these models, right, when it comes to multi-factor investing, are back tested extensively on actual historical data, as you know, whatever has happened. It is not a good indicator of future performance. So there is a model risk, because models rely heavily on historical data and assumptions that may not hold true in changing market conditions. Now if you look at last 10 or 20 years data, right, we are including years like 2005, 2006, 2007, the market was quite different back then, right? There was not so much liquidity, there were not so many retail investors, the mutual fund industry itself was quite small back then. But now the factors have changed, right? So relying completely on a model to decide stock allocation is can be risky, right? The second risk in multi-factor funds is that high turnover risk, right? Because it requires frequent portfolio rebalancing. As you saw, as I explained to you earlier, depending on the market cycle, if the market changes from say bull to bear, the model or the portfolio has to be changed from momentum stocks to maybe quality stocks and low volatility stocks, which means there are frequent portfolio changes. The stock composition of the portfolio changes. The fund manager has to buy and sell stocks more frequently than most other categories of mutual funds. It increases transaction costs, right? So over a period of time, the transaction costs in terms of the brokerage that is paid any other transaction cost like stamp duty and all that stuff, they tend to add up, and over a period of time this category might have a slightly higher expense ratio than other categories which are not multi-factor funds, because over here obviously the stock turnover is going to be higher than most other categories. The third risk is that concentration risk, right? Because the model is looking only at factors, right? So if, let's say, during a bull phase it identifies that the portfolio should be heavily biased towards momentum stocks, it might happen that your fund or a particular fund tends to become dominated by particular sectors, right? Because there are certain sectors which are cyclical, and because they are cyclical they are inherently momentum stocks. So examples of cyclical structure industries are IT industries, right? Because you will see, once IT stocks start booming because of demand from whatever, USA or Europe, they keep booming, and the model may decide that, okay, these are the momentum stocks, and because the market is in a bull phase, the most of the portfolio should be shifted to momentum stocks. So it is quite possible that that particular fund may become very heavily concentrated on IT sector stocks or any other sector which is cyclical or momentum in nature, right? So this is a risk, and unfortunately, it cannot be prevented because this is ultimately a model-driven decision. The human judgment factor is not that much here. If this was an actively managed fund, although this is an actively managed fund, but the fund manager here has very little discretion. If the model says that, okay, this is a bull phase and these are the stocks, momentum stocks that have to be included in the portfolio, the fund manager typically will have to include those stocks only, right? So these are some of the risks in multi-factor funds. Now remember, this is a very, very recent category. Okay, multi-factor fund. I think there are not too many funds. I could only find Bandhan multi-factor fund and Sundaram multi-factor fund, and their AUMs are also quite comparatively low, right? So around 500 CR and 800 CR. But if this category does well, maybe over the next 1 or 2 years, you might find, some other fund houses launching, these kind of funds. Remember, multi-factor mutual funds are still high risk. You may combine multiple factors and, model-based decisions and all, but still this is a pure equity mutual fund, and the risk is very high. So that was about multi-factor funds. Now, are you a first-time investor? Have you never invested in mutual funds before? If yes, or if you are new to mutual funds, there is a good news for you, right? Is that investing in mutual funds is a fully online process. You don't have to submit any Xerox copies, you don't have to fill any forms. All you need is an Aadhaar card number, PAN card number, and a cancel check photo. What do? You scan this QR code on the right, you download the Funds Bazaar app, or you click on the link given in the video description, go to the Funds Bazaar website, and you enter your name, mobile number, and email ID. You'll get two OTPs, one on your mobile number, one on your email ID. You enter those so that your email ID and mobile number is verified. After that, there is a very small KYC process in which you have to, enter your Aadhaar number, PAN card number, and upload the cancel check photo. Once that is done, you are ready to invest in any mutual fund schemes. So if you like multi-factor mutual fund scheme based on this discussion and any other research that you do, you can invest in any of the multi-factor schemes that are available. I am a registered mutual fund advisor and distributor. During this entire process, if you face any difficulty, you can contact me on this WhatsApp number 975730929. I would definitely help you in terms of, getting registered on this app and getting your KYC process completed, and also I can help you in suggesting the right mutual fund schemes for you. So this was about multi-factor funds, a very new category in the Indian mutual fund world. I hope you found this video insightful and informative. I look forward to educating you or informing you on many other mutual fund categories and any many other mutual fund concepts in a very simple to understand way. Thank you for watching this video, and keep watching this channel for more.